the Bank of Baroda management joining us, Mr. P.S. Jayakumar. Good morning, Mr. Jayakumar. Thank you very much. Let me start straight away with the difficult question of asset quality. While year on year there is a definite improvement, I mean the additional assets, bad assets were like what, 26,000 crore last year. This year, after the 4 quarters, you'll have added a net of only 11,000 crores. But the concern comes from the fact that quarter on quarter, it's 4,000 crore slippages, third quarter, 4,000 crore slippages in the fourth quarter, third and fourth quarters. When do we start to see it tapering down?
So let me kind of answer your question in this manner. Given the nature of the portfolio of the large corporate accounts, the accounts are fairly lumpy. It is not possible, I think, to have look at a certain projection divided by 4 and say we should have equal in every quarter. Nor is it when the numbers are up, they're necessarily bad. Nor does it mean when it is down, it's really down. So it's a process. We have a certain amount of embedded risk arising from the past that is there. We have to deal with it. And the way we are trying to deal with it is to take the coverage ratio up, recognize that potentially new problems can also emerge, which we don't see today, and be careful about the whole thing. But even while doing so, we have to go forward with the overall energy, the transformation process we are in, and to do our best to reduce the gap between us and the best of breed of our competitors, and aspirationally go ahead of them. So that is a marathon journey. We are into it, and we are pleased with the progress we are making over there.
Okay, I won't ask you.
That process starts to.
Okay, not quarterly, sir. For FY18, therefore, since FY16 to 17, there is a sizable overall reduction in the fresh slippages. Can we expect that in FY18, this will be, say, half of what it was in FY17?
See, FY16 is a very unusual year.
Yes.
It was not only a slippage on account of the fact accounts slipped, a lot of it was also recognition of NPAs that could have been recognized earlier. So there was a certain amount of bunching up, if you will say. At this point of time, where are the risks that are there? You know, we, in our book, as well as in many of the banks' book, there are a couple of large accounts which could potentially slip into NPA, but beyond a few of them, we don't see much of a downside. We don't exactly know whether these accounts will become NPA or when they will become, but we need to be prepared for it. Yeah. We have a fair amount of exposure to the SME industry, and it's a granular portfolio. The management of it is very different from managing of large portfolio. We must be open to looking at risk over there. We must also be conscious about the risk in the agricultural portfolio. Okay. So there are as you can say, risks all around, but I think but I think on the balance, I think we should be able to contain them, take the provision coverage up, reduce our net NPA number both in percentage term and in absolute term as we come to the end of 2018. Okay. I'm fairly confident that we will reach a very solid fortress type of balance sheet by September 2018.
Okay, Mr. Jayakumar, good morning. The other thing that the street liked this time around was the improvement in the domestic loan growth, almost about 5.5% or so. How much do you think domestic loan growth could increase in fiscal FY18? And if you could break that up for us in terms of retail and how the rural book could grow?
Okay. See, there are two things over here. One, when you look at the growth itself, and you have to look at the number between April of 16 to, say, December of 16, it was a negative number. We had a significant pickup in March, which was almost a 10% growth across our domestic book, and an equivalent number in the international book, except that the rupee conversion of them is converted on a rupee basis. That is somewhat lower. We feel fairly confident about the growth of both the corporate and the retail book. We are looking forward for a 20% growth in the retail portfolio. If I were to look at it, it was about 17% in the prior period. But then that 17% was working off a smaller base. So we're looking at 20% in this year. As far as corporate growth is concerned, we certainly are looking at a 10% kind of growth number, probably a little bit more depending on how these things play out. But we are having two factors that kind of support that. One is that overall macroeconomic itself is improving. The monsoon is expected to be good, and some of the capex cycle is returning, so there should be opportunity for growth. And more important, and equally important, is the fact that clients are with large number of banks, they're also trying to consolidate the account. Given the fact we have relatively smaller exposures to a lot of them, there is opportunity for us to look for consolidation on that phase. So both of these opportunities exist, but again, it may not happen in June, it may happen in September. We really can't say it's going to be equal. The first quarter for us usually is impacted by transfers, changes, prepare audit of accounts, the financial year, etc. And so the first quarter generally turns out to be a little bit slack, but I'm fairly comfortable that starting next quarter we will do very well.
Okay, so we are just about...
Overall, I think the guidance, we will stay there.
Okay, sorry, we are just about a couple of minutes for the markets to open. So if you can tell us what your credit cost will be in FY18, as well if you can give us some idea of any capital requirement.
I will take the second question first, and then I'll come back to the credit cost. As far as capital requirement is concerned, requirements for the purpose of taking care of our balance sheet, the balance sheet challenges, NPAs, etc., is zero. We don't need any capital for that purpose. We've been saying that consistently, and it remains the case. As far as capital for growth is concerned, it's always a good thing if the balance sheet, I'm getting an echo, the balance sheet grows strongly. But as looking into the first quarter and the second quarter, we're not really looking into the first quarter. We're not really anticipating any increase in equity. Let us get the growth. Let's get the trajectory for it, and then we can look at raising equity capital. The stock prices are also beginning to look much more favorable.
Credit cost?
Now, credit cost. We have to create a range of scenarios. What happens if things play to a plan, which is all of us hope, resolutions, etc., and then what happens if things don't play to the course. Overall, I think we will be overall a profitable bank. But if the outcomes come out the way all of us would like to, which is a lot of resolution of large accounts, then we are looking clearly at a double-digit return on equity. Okay. And correspondingly, the credit costs would also move correspondingly. So on the balance, should I say cautiously optimistic, and we have a lot of things to do, but I hope we'll get there.
Okay, Mr. Jayakumar, thanks a lot.